Back myself Gokul. I'm working as an assistant professor, the Department of Master of Business Administration, still to one and today we are going to see the subject of financial management and the subject code is MB25201. It comes under the regulation 2025. In this video, we are going to see the part 3 of Unit 2, Investment and Capital Decisions. Having understood what capital budgeting is and what factors it is, we now turn to the most practical aspects, the techniques used to evaluate investment proposals. Today, we will cover the main capital budgeting techniques like payback period, discounted payback period, then NPV net present value, IRR, internal rate of return, and profitability index. We will also touch on the accounting rate of return method in this video. Capital budgeting techniques falls into two broad categories. One is non-discounted method and second is discounted method. Non-discounted method means it does not consider time value of money. Example payback period, then discounted method. Discounted method it considers time value of money. Examples LPV, IRR. LPV means net present value. IRR is internal rate of return. Let's start with the simplest method in the next slides. First, we will see about the payback period. The payback period is the simplest and most widely used method in India. It calculates the time required to recover the initial investments from the project's cash inflows. For example, if a project cost 5 lakh, generate 1 lakh per year means the payback period is 5 years. This means 1 lakh into 5, it takes 5 lakhs, 5 years. That's so it's popular because it's easy to compute and understand, and it gives a quick sense of a project's liquidity and risk. Then accounting rate of return, which is ARR. The accounting rate of return method differs from payback that it considers the project's total profitability over its entire life, not just the payback period. For the payback period, we have taken the 5 lakhs, 1 lakh for the 1 year means then 5 lakh means 5 years. Like that we have seen. But in the accounting rate of return, it was completely different. Why means they will take consider the entire life of the not for the particular projects. So that's the difference between the payback and the accounting rate of return. ARR calculates the average annual profit as a percentage of the initial investment. Different variation of ARR can be used for different analytical purposes. Then advantages of payback period, disadvantage of payback period. Let's first see about the advantages of payback period. First point is it's simple, which means it's simple to compute and easy to understand. Second, it provides information about liquidity so that find, we can see how quickly the funds are recovered from the projects, from the each projects. Then third, reduces risk. It reduces risk of loss by focusing on early recovery. Then last, disadvantages of payback period method. However, payback period has significant limitations. First point, it ignores time value of money. A rupee today is worth more than a rupee tomorrow. Second, emphasis liquidity over profitability. A project with quick return may not be most profitable. Then third, ignores salvage value. Salvage means scrap value. It doesn't consider terminal value of assets. Then fourth, ignores post payback cash flows. It returns after the payback period are completely disregarded. These limitations led to the development of discounted methods. Then discounted payback period method. It's an improved method from the payback period method. The discounted payback period addresses one major flaw by incorporating the time value of money. Here, future cash inflows are discounted to their present value using an appropriate discount rate before calculating the payback period. This method gives a more accurate picture of how long it takes to recover the initial investment in today's rupees. Then net present value. The net present value method is considered the gold standard in capital budgeting. It calculates the present value of all future cash flows. This means both cash inflows and cash outflows, discounted at the firm's cost of capital. The decision rule for the net present value, uh, if NPV, which means net present value greater than zero, means we have to accept the project, which means it adds value to the company. So we can definitely accept the project. There will be a much profit or enough profit for the company. Then second decision, NPV less than zero means we have to reject the project. It destroys the value of the company. There will not be profit. There will be heavy loss. So we have to take consider all these projects. We should not accept the projects. Then final rule NPV equal to zero. The project break evens with no profit, no loss. Whatever the money we have invested in the project, we will get that money one day. We will not get profit or we will not go under the loss. So that's the final rule. NPV directly measures the expected increase in shareholders' wealth. Then internal rate of return. The internal rate of return is the discount rate that makes the NPV equal to zero. In other words, it's the project's expected rate of return. For IRR also, there is some decision rules. First rule is if IRR greater than the cost of capital means we have to accept the cost of capital means we are getting money from the bank or financial institution. For that, they will set some percentage, which means like an interest rate we have to pay for the yearly or monthly from the profit we have earned. So we have to take consider the cost of capital to the IRR. If the IRR is greater than the cost of capital, means we have to accept the project. Second rule, if IRR less than the cost of capital means we have to reject the project. So the IRR is intuitive because managers think in terms of returns, but it has limitations when comparing mutual exclusive projects. Then probability index. The probability index, also called as benefit cost ratio, it is the ratio of the present value of future inflow to the initial investment. For that probability index, there is some decision rule. If Probability index is greater than the one means we have to accept the project. If the probability index less than the one means we have to reject the project. Simple the net present value only. For the net present value, we will compare with the zero, and here we will compare with the one. That's the difference. But the formula is also same as per the NPV. So we can take consider either the NPV or the probability index. It depends upon the finance manager or accounts manager of the firm, or it depends upon the project value, or depends upon the project timing. It's particularly useful when capital is rationed and you need to rank projects by efficiency. That covers the main capital budgeting technique in part 3. In part 4, we will explore the cost of capital, a critical input for all discounted cash flow methods, and how to calculate the cost of different source outputs. If you found this video helpful, please don't forget to like, share, and subscribe. Leave your questions in the comment. Thank you and see you in the next part.